This is Wes Moss with a live Money Matters update, and I'm here to talk about one of the scariest weeks we've had in the stock market, arguably since the 1987 crash. And I want to draw out this market. There was so much fear on Monday and Tuesday, or really Friday and Monday and Tuesday, that investors were shaken by what was over a 1,600 point drop, 1,600 point drop just in one day. And that followed a 665 point drop the day before. So we have been, markets have been on a wild ride. And if you've looked at your 401k or you've looked at your investments, you probably thought to yourself, hey, is this the big one? Is this the next mega recession, mega 2008 stock market crash again, 2000, 2001 stock market crash? Are we headed back there to the depths of that? And of course, that brings up a lot of emotion, and we get nervous as investors. So I want to look at what the market did briefly. I'm going to draw this out. I want to talk about the frequency of corrections, help you understand the history. And I also want to look at a year, 2 decades ago or 3 decades ago now, that is an analogy to, or analogous to, what's happening potentially this year, so I can give you some context about these corrections and what they mean in any given year. So stay tuned. We're talking about the recent market action that was dramatic over the past, call it 7-8 trading days. Here's really what this looked like. We're going to draw this out, and this is mostly January. And then, of course, here we are in February. It's 2018. And this is the Dow Jones average that started the year at about 24,700 and had this remarkable climb higher and higher and higher until the very end of January. The market, or the Dow Jones, was up approximately 1,900 points, or 7.5%, just in the month of January. A remarkable rate of return. If we kept that same return up and multiplied it over the course of the next 11 months, the market would go up 150+% in the year. We know that can't happen, never has happened, but this is how the year started. Then, all of a sudden, the air started to kind of let out of the balloon, if you will, and then the stock market essentially dropped and then cascaded even further, down about 2,300 points over the course of just a couple of days. So we hit, the Dow went from 26,600 way up here, all the way down to about 24,345. Just a dramatic move, and it really scared a lot of folks. So the Dow went from 26,000 approximately 600 down to 24,345. And then here we are today with some recovery. We're back up about 855 points to 25,200, up around 2% on the year. Remember, we were up 7.5% on the year. So that's what this market has looked like. It's dramatic. Now, what's also really important to remember is that as markets go up and up and up and get higher and higher, every point means less on a percentage basis. So so points don't matter. Percentages matter. And now that we're at a much more elevated Dow that's been going up for the last 9 years, well, 1%, a 1% move now, it has to be a lot more points than back when the Dow was at 7,000 or 8,000 or 9,000. So now, at a Dow, let's say when the Dow's at 25,000, you need 250 points to equal 1%. Remember that over the course of history, 0.75% in any given day is about average. So now we have, and it's important for everyone to remember, the law of large numbers really makes for headline-grabbing numbers, triple-digit losses, triple-digit gains. Triple digits doesn't mean as much today with the Dow 25,000 as it did back when the Dow was at 6,000 and 7,000 at the depths of the recession. So that's what the chart looks like. A couple of really important points here, and I want to talk about why this happened or what this means for the economy. And then really, where do we go from here? What does this mean? And is this normal or is it not normal? The next really important piece of the equation is there's a combination of reasons why this happened. One, typically we see these market pullbacks because we're worried about growth slowing down. Here, the market is worried about growth accelerating or going from warm to hot. Why is that a bad thing? Well, that can be detrimental because as the economy overheats, then the Federal Reserve has to raise interest rates and ultimately puts the brakes on the economy, and then it can then in turn slow the economy back down. So it kind of ends the economic boom cycle. And if we get inflation like we've just started to see and interest rates go up, that could spell kind of the latter innings of an economic cycle. And that's why the market got so worried. The other really important piece of the equation here is that we went for almost 2 full years without even a blip on the radar. That's very rare, almost unprecedented in markets. On average, the stock market has a 5% correction about every 10 weeks over the course of history. Every 10 weeks. We have 10% corrections, again, over the course of history, every 33 weeks. We have 20% corrections on average every, call it 2.5 years. Well, we had gotten very, very overextended, meaning that as far as corrections were concerned, we had gone over a year and a half without even a 5% correction. What? We have still, now we did hit intraday down 10% on the Dow, but again, this typically, we've gone over 2 years without really closing below the 10% mark versus on average 33 weeks. And we're still not even close to a 20% correction, and we're about 9 years in. Historically, 2.5 is the average. So we were, to some extent, long overdue. And when that happens, there's a lot of money in the market, and you and I, hopefully, I am a long-term investor, so I'm not hopping in and out of the market in any given day. And if it's your 401k, you're thinking about that's long-term money. You don't want to touch it for 10 and 20 and 30 years. But there's a big part of Wall Street that operates on a minute-to-minute basis, a day-to-day basis, a week-to-week basis. So they are trying to game the system to get out before the market drops 3%, get back in once it drops. So it's as if their finger is on the trigger. And when you have a scenario where the markets were so placid and basically did nothing, traders were expecting, hey, we're going to get a correction, but it went so long that as soon as the air started to go out of the balloon, if you will, everyone stampeded for the exits. And that is a big part of why you saw this cascade lower. It wasn't just a couple hundred points lower, it was down 650 or down over about 1,100 points a week ago. Then on Monday, the following Monday, down 1,600 points in one day. Now we've recovered from that pretty significantly, so the market may have found some equilibrium here. It's too early to call whether this volatility or correction is over, but we did go down by about 8.5%, and again, very, very quickly. So the market was overdue, and it's not just because it's overdue, it's because traders were all trying to get to the door the quickest or very quickly, knowing that at some point this is going to happen. You couple that with the interest rates starting to go up, and that's a big part of the formula of why this correction happened. So it's actually a good thing that we've gotten some corrective activity over the last several trading days, and it helps to kind of reset the market. The other thing is super important here. When stocks fall, because the economy is actually getting better, and that's the fundamental backdrop of what's really important in markets, as the economy is getting better, when stocks go down, they just get less expensive because earnings are actually still going up. It's a very different story when growth slows down. In this environment, we see the economy strong, unemployment at 4.5%, wages going up at 2.9%, housing inventory is tight, consumer confidence is high. So the economy is strong and getting stronger. So that means company earnings are strong and getting stronger, not to mention tax reform that's just starting to hit wallets in America to the upside. So we think the economy is going to continue to get stronger, and you put all that together, you have a scenario where when stock prices go down, they become they can become a very good deal because earnings still aren't going down. So valuations get cheaper and cheaper, and that's part of the reason why we might have been seeing this equilibrium in the last couple days where markets have come back up pretty significantly. So again, there's a lot of emotion tied to these downdrafts. They seem to be getting more violent and more acute as computer algorithms are a big part of Wall Street now. But we've got to remember that the corrections are a natural course of history. I just gave you the history of how often it happens. Here's another an analog to 2018. I went back with one of our research teams and looked at the 20 best January performances that we've seen since 1950. 2018 January kind of fits right in the middle. We've had some double-digit Januaries to start out the year on the upside, all the way to number 20 on the list is a 4% rise in January. We were at about 7.5% for January. Well, in that year, it looks a lot like 1980. The market was up about 6% in January. It finished the year a net positive about 26%. So the first month was gangbusters, up about 6. It finished up 26% for the full year. But it wasn't without a correction. In fact, during that year in 1980, markets dropped 17%. So again, a full 10% more, or almost 10% more than we've even seen in this violent correction. A full 10% more than that, or almost, down 17% during that year, yet the year still finished net positive, almost 26%. Really important to remember, even with really solid years or good years historically in markets, for the S&P 500 and the Dow is very similar to this, they are not without big pullbacks. They're not without corrections. That is the normal course of investing. I think investors kind of got complacent and forgot about that because we've had such an escalator type last couple of years. But volatility is back. So where do we go from here? One, we've got to remember I'm not panicking because I do think fundamentally the economy is good. Number two, we have to remember that we were in a period of abnormal lack of volatility, and I think now we're back to a period of time where we're going to see more 1% moves. And remember, 1% today on the Dow is a 200-plus point move before we can get to 1%. So remember that next time you see headlines, triple-digit gains, triple-digit losses. Well, it makes sense that almost every day now should be a triple-digit move in either direction or either direction due to math, the law of large numbers. So I don't want folks to panic. Again, I think the economy is in decent shape and actually good shape and getting stronger. Remember that investing isn't easy. It's not an escalator going one direction. The escalator moves in both directions. There's a lot of risk associated with markets, a lot of emotion, a lot of angst. And quite frankly, there should be, because you look at long-term returns, you're looking at 9 to 11% average annual returns. There's got to be a little bit of a price for that wonderful or that strong rate of return relative to other asset classes over time. Hope this was helpful. If you need to find me and the team or have questions, we're happy to help. You can go to my website, wesmoss.com, WESMOSS.com. Subscribe to the YouTube channel. We frequently update it. The YouTube channel is Wes Moss Money Matters, just WESMOSS Money Matters. Thank you so much for tuning in. Have a profitable rest of your day.